Before we begin, a quick disclaimer. I am not a licensed financial advisor or insurance agent. This presentation is for educational and informational purposes only and should not be considered financial or legal advice. Every individual situation is unique, so please consult with a qualified professional before making any financial decisions regarding your insurance coverage. The renewal notice arrived in a plain white envelope. I almost threw it out with the junk mail, but when I opened it, my stomach dropped. My 6-month premium had jumped by $220. $220? For what? I hadn't gotten a ticket. I hadn't been in an accident. My car was a year older, worth less, not more. I hadn't moved. Nothing had changed. Felt like a fine. A penalty for being a loyal customer. I was furious. Not just at the number, but at the sheer audacity of it. It felt like they were counting on me to just sigh, complain to my spouse, and then pay it. Because that's what most people do. And that's the first secret they don't want you to know. Your loyalty is costing you a fortune. This isn't just my story. A recent study found that the average American driver overpays for car insurance by over $450 every single year. Think about that. That's a new set of tires. It's a weekend getaway. It's a significant payment on a credit card. It's money that you earned, being systematically siphoned from your bank account for absolutely no reason other than inertia. This video is your playbook to get that money back. We are going to expose the industry's tricks, demystify the jargon, and give you a step-by-step, proven battle plan to slash your car insurance rate. We're not talking about clipping coupons for a $5 discount. We are talking about fundamental strategies that can put hundreds, or for some of you, even over $1,000 a year back where it belongs, in your pocket. So let's start with the biggest lie in the entire industry, the loyalty penalty. Insurance companies love to talk about rewarding loyal customers. They send you little emails on your policy anniversary. But behind the scenes, many are using a controversial practice called price optimization. It's a fancy term for a simple, brutal calculation. They use sophisticated software to analyze your data and predict how likely you are to shop around for a better rate. Are you the type of person who just auto-renews without thinking? Do you hate the hassle of getting quotes? If their algorithm flags you as a sticky customer, someone unlikely to leave, they can incrementally raise your rates year after year, knowing you'll probably just pay it. Your good driving record becomes irrelevant. The fact you've paid them on time for 10 years straight means nothing. They are betting on your complacency, and for millions of Americans, it's a bet they win every 6 months. Your greatest weapon against this is incredibly simple, yet criminally underused. It is the single most powerful, most effective way to lower your car insurance rate, and it is this: you must shop around. I know. Sounds boring. Sounds like a hassle. You're busy. You'd rather do literally anything else. The insurance companies have spent billions of dollars on advertising to make you feel like switching is a complicated, painful process. It's not. It's the one thing they are terrified you will actually do. Because when you shop around, you break their algorithm. You signal to the market that you are an active, informed consumer, not a passive source of revenue. You force them to compete for your business, and that is when the power shifts from them back to you. So how do you do it right? First, this is not a one-time thing. You need to make this a habit. Mark it on your calendar. At least once a year, or every time your policy is up for renewal, you dedicate 1 hour to rate shopping. Think of it as a job that pays you $200 or $300 an hour. There's no other side hustle that has that kind of return on your time. Second, you have to know where to look. There are 3 main ways to get quotes. The first is using an online insurance marketplace or aggregator. These are websites where you put your information in once, and they spit out quotes from a dozen different companies. This is the fastest way to get a bird's-eye view of the market. It's fantastic for quickly identifying who the most competitive players are in your area for someone with your profile. The second method is going directly to the insurance companies themselves. Some of the big players don't participate in those comparison sites. So after you've used an aggregator, take the top 2 or 3 cheapest quotes and then go directly to the websites of a few major companies that weren't on the list and get quotes from them too. This ensures you're not missing out on a direct-to-consumer deal. The third, and often overlooked method, is contacting an independent insurance agent. These are not people who work for one company. They are brokers who work for you. They have relationships with multiple insurance carriers, including smaller, regional ones you've never even heard of that might offer incredible rates. A good independent agent can be your secret weapon. They do the shopping for you, they understand the nuances of the policies, and they can often find hidden discounts you wouldn't have found on your own. Using a combination of all three methods, aggregator, direct, and agent, is the ultimate trifecta. It ensures you have covered the entire market and are truly finding the absolute best rate possible. Now, here is the most critical part of shopping around and where most people make a huge mistake. You must, and I mean must, compare apples to apples. A cheap quote is worthless if it provides you with dangerously low coverage. When you get these quotes, you need to have your current policy's declaration page right in front of you. This is the document that lists out all your coverages and limits. You need to make sure every new quote you get has the exact same numbers. Pay close attention to your liability limits. This is typically written as 3 numbers, like 100/300/50. That means $100,000 for bodily injury per person, $300,000 per accident, and $50,000 for property damage. Do not let a company give you a teaser rate by dropping these numbers down to the state minimum. That's a recipe for financial ruin if you're ever in a serious accident. Next, look at your collision and comprehensive deductibles. That's the amount you have to pay out of pocket before the insurance kicks in. If your current deductible is $500, make sure every quote you get is also for a $500 deductible. A company can make their premium look $10 cheaper by quoting you a $1,000 deductible, but that's not a true comparison. You need to match every single line item: uninsured motorist coverage, personal injury protection, rental reimbursement, roadside assistance. Everything. Only when the coverages are identical can you truly compare the prices. Once you have 3 to 5 of these identical apples-to-apples quotes, the choice becomes simple. You call your current provider, you tell them about the better offer you have, and you give them one chance to match it or beat it. Sometimes miraculously, they will find a new discount they forgot to tell you about. Other times they won't, and that's when you thank them for their service and you switch. No emotion, no misplaced loyalty. It is a business transaction, and you are simply choosing the best value for your money. But to get the best value, you have to understand the game you're playing. See, car insurance isn't priced based on feelings or loyalty. It's priced by a cold, hard, calculating algorithm, a black box. You feed in your information, your age, your car, your address, and it spits out a number. Your premium. Most people just accept that number. They think it's fixed like a law of physics. But it's not. The algorithm is just a machine that calculates risk. Your job, your mission, is to make yourself look like the safest, most boring, least risky person on the planet to that algorithm. You have to learn how to speak its language. And its language is data. So let's pull back the curtain and look at the core pillars of this secret formula. These are the big levers that move your rate up or down, and understanding them is the difference between paying $400 a month and paying $80. The first one, and I'm starting here because it's the one that shocks the most people, is not your driving record. It's your credit score. Yes, your credit score. In every state except California, Hawaii, Massachusetts, and Michigan, insurance companies are legally allowed to use a version of your credit history to determine your rate. They call it an insurance score, but it's heavily based on the same information in your credit report. Now you might be thinking, what does my ability to pay my Visa bill on time have to do with my ability to merge onto a highway? And that's a fair question. The answer is correlation. Decades of actuarial data have shown insurance companies that, on average, people with lower credit scores file more claims. Not just more at-fault accident claims, but more claims of every kind. Maybe they're under more financial stress and drive more erratically. Maybe they're less likely to perform regular maintenance on their car, leading to equipment failure. The why doesn't matter to the algorithm. It only cares about the data. And the data says low credit equals high risk. How much does it matter? It's staggering. A study by the Zebra found that moving from very poor credit to exceptional credit can cut your insurance premium by more than half. In some states, having a poor credit score can increase your rate more than a DUI conviction. Let that sink in. The algorithm can view your financial habits as a bigger red flag than you getting behind the wheel while intoxicated. It's a brutal, unforgiving calculation, but it's also your first massive opportunity. We're going to dedicate an entire future part of this series to how you can rapidly improve your credit score for insurance purposes. But for now, the takeaway is this. Your insurance rate is a direct reflection of your financial health. If you want to fix one, you have to pay attention to the other. The second pillar of the algorithm is the car itself. This seems obvious, but people get the details wrong. They think it's as simple as sports cars are expensive, minivans are cheap. The reality is far more nuanced. The algorithm looks at your car through three specific lenses. First, the cost to repair it. A 2023 Honda Civic and a 2023 Mercedes C-Class might have similar sticker prices, but the Mercedes is loaded with expensive, proprietary sensors, cameras, and computers. A minor fender bender in the Civic might be a $2,000 body shop visit. The same incident in the Mercedes could be a $10,000 bill to replace and recalibrate all the electronics in the bumper. The algorithm knows this, and it prices your collision coverage accordingly. Second, it looks at safety. How well does your car protect you and your passengers in a crash? Insurance companies obsess over data from the Insurance Institute for Highway Safety, or IIHS. A car with the top Safety Pick Plus rating is statistically proven to result in fewer and less severe injuries. Fewer injuries mean smaller medical payouts for the insurance company. They reward this with lower premiums, specifically on the portions of your policy that cover medical payments and bodily injury liability. Driving a safer car isn't just good for you, it's good for your wallet. And the third lens is theft. Every year, a list comes out called the Hot Wheels Report, which names the most stolen vehicles in America. For years, it's been dominated by things like Honda Civics, Honda Accords, and full-size Ford and Chevy pickups. If you own one of these vehicles, especially a slightly older model without modern anti-theft technology, the algorithm sees a giant flashing neon sign that says, "Theft Risk." It will jack up the price of your comprehensive coverage, which is what pays out if your car is stolen. And that old myth about red cars costing more to insure? It's completely false. The color has zero impact. What's true is that certain models of cars that are popular with aggressive drivers also happen to be popular in the color red. The algorithm isn't penalizing the color. It's penalizing the crash statistics of the specific make and model. The third pillar is where you park your car at night. Your zip code. This is another one that feels deeply unfair to a lot of people. You could be the world's safest driver, with a perfect record and a perfect credit score. But if you move 2 blocks over into a different zip code, your rate could jump by 30%. Why? Because you're not just being rated on yourself. You're being rated on the collective risk of your neighbors. The algorithm looks at your zip code and asks, how dense is the population? More cars in a smaller area means a higher likelihood of accidents. What's the crime rate? Higher rates of theft and vandalism mean a higher chance of a comprehensive claim. What's the weather like? A zip code in Oklahoma's Tornado Alley or Florida's Hurricane Corridor is going to have much higher comprehensive rates than one in San Diego. It even looks at how many lawsuits are filed. Some areas have more litigious populations and more lawyers who advertise for accident victims, which drives up the cost of bodily injury claims for everyone in that area. You are, quite literally, paying for the sins of your neighbors. It's not fair, but it's how the math works. Finally, we get to the pillar that everyone thinks is the only pillar, your personal profile and driving habits. This includes the obvious stuff. Your age. Drivers under 25, especially males, are statistically a nightmare for insurance companies. Their rates are astronomical because the data shows they crash at an alarmingly high rate. Your driving record. Yes, speeding tickets, at-fault accidents, and DUIs will absolutely hammer your premium for 3 to 5 years, sometimes longer for major violations. But it also includes something much more subtle, something you have direct control over right now, your stated annual mileage. When you got your policy, you probably guessed how many miles you drive a year. 10,000? 15,000? Many people set this number years ago and never thought about it again. But what if your life has changed? What if you used to have a 45-minute commute, but now you work from home 3 days a week? Or maybe you work fully remote. You could have dropped your annual mileage from 15,000 down to 5,000, but you're still paying the premium of a supercommuter. You are paying for risk you are no longer creating. Updating this single number can result in an immediate 5 to 10% discount. It is one of the easiest wins available. So those are the 4 pillars of the algorithm: your credit, your car, your location, and your personal profile. Your entire insurance premium is built on this foundation. Everything else, all the discounts and special programs, is just decoration on top of this core structure. Your power comes from no longer seeing your premium as a random number, but as the output of a system whose rules you now understand. And once you understand the rules, you can start to win the game. Now that we've pulled back the curtain on what the insurance companies are looking at, the next step is to go on the offensive. We need to attack each of these factors one by one and bend them to our will. And we're going to start with the secret world of discounts, the dozens of price cuts worth hundreds, even thousands of dollars that most people don't even know exist, and that your insurance agent will almost never volunteer on their own. Think of your insurance policy not as a fixed price, but as a starting bid in an auction where you're the only one who doesn't know you can negotiate. The insurance company sets a high opening price, and they are perfectly happy if you just pay it without question. Why wouldn't they be? Every dollar you overpay is a dollar straight to their bottom line. The agent on the phone? They're often incentivized by commission or performance metrics that don't prioritize saving you money. Their job is to sign you up and keep you paying, not to be your financial advisor. So, you have to become your own advocate. You have to walk into the negotiation armed with the secret list of cheat codes. Let's break them down into 4 main categories, and I want you to grab a pen or open a notes app because you're going to make a checklist. First, discounts based on you, the driver. Second, discounts based on your car. Third, discounts based on how your policy is set up. And fourth, the one almost everyone misses, discounts based on who you are and where you work. Let's start with you, the driver. The most common one you hear about is the good student discount. But most people think this is just for teenagers getting their license. That's mistake number 1. Many insurers offer this all the way through college, and some even for a year or 2 after graduation, as long as you maintained a B average or a 3.0 GPA. If you have a young driver on your policy who's in college, or even recently graduated, that's a phone call you need to make right now. It can be a cut of 15 to 25%. That's not pocket change. Next, the defensive driving course. This is one of the best return on investments in personal finance. You pay maybe $30 or $40 for a state-approved course, which you can almost always do online in a few hours. You send the certificate to your insurer and boom, you get a discount, often around 10%, that lasts for 3 years. Let's do the math. If your insurance is $2,000 a year, that's a $200 savings each year. Over 3 years, that's $600 back in your pocket from a $40 investment. You will not find that return on Wall Street. You have to ask for it, they will not offer it. Then there's the big one. The safe driver discount, also called the accident-free or claims-free discount. This isn't just a single discount, it's a ladder. The longer you go without an accident or a major ticket, the higher you climb and the more you save. 3 years might be a 10% discount. 5 years could be 20 or even 30%. If you've just passed a major milestone like 5 years accident-free, call them. Their system should catch it, but you can't trust their system. Your money is on the line, not theirs. This is also where the controversial topic of telematics comes in. Those little plug-in devices or phone apps like Progressive Snapshot that track your driving. They monitor your braking, acceleration, and the time of day you drive to prove you're a safe driver in real time. We'll do a deep dive on whether those are a good idea or a privacy nightmare later in this series, but it's a powerful way to claim this discount if you're a genuinely good driver. Now for the second category, your vehicle. This is where you can find a ton of hidden savings. Your insurance company gets basic information about your car from its vehicle identification number, or VIN. But these databases are often incomplete, especially when it comes to specific safety features. You need to tell them what you have. Anti-lock brakes are standard now, but what about anti-theft systems? Do you have a passive alarm that arms itself automatically? Or better yet, a GPS tracking system like LoJack? Those can slash the comprehensive portion of your premium. What about safety features? Airbags, yes, but what about the new stuff? Blind spot monitoring? Lane keep assist? Automatic emergency braking? These technologies are proven to reduce accidents, and insurers know it. They offer discounts for them, but only if they know you have them. Make a list of every single safety feature in your car. Go through the owner's manual if you have to, and read that list to your agent. Each one might only be a 1 or 2% discount, but when you stack 5 of them together, you're making a real dent. And here's a huge one for the post-pandemic world: the low-mileage discount. Millions of people in America are now working from home or have a hybrid schedule. They used to drive 15,000 miles a year commuting, and now they drive 5,000. But did they tell their insurance company? Probably not. The risk of you getting in an accident is directly tied to how much you're on the road. If your driving has been cut in half, your premium should reflect that. Check your odometer. The thresholds are usually around 12,000, 10,000, and a big one at 7,500 miles per year. If you're driving less, it is financial malpractice not to report it. Okay, category 3, your policy itself. This is about how you structure the deal. The most famous discount in all of insurance is bundling. Combining your auto insurance with your homeowner's or renter's insurance. They give you a discount not because they're nice, but because it makes you a sticky customer. It's harder for you to leave if you have to unwind multiple policies. But you can use that to your advantage. The discount is often substantial, between 10 and 25% on both policies. Don't just stop at home and auto. Ask about bundling with life insurance, umbrella insurance, even pet insurance. Squeeze every drop out of that bundle. Next is the paid in full discount. If you're paying your premium monthly, you are paying a penalty. It might be listed as an installment fee of a few dollars a month, or they might just bake a higher rate into the monthly price. If you have the cash flow to pay your 6-month or 1-year premium all at once, you can often save 5 to 10% instantly. That's free money for doing nothing but changing a payment schedule. While you're at it, ask about discounts for going paperless and setting up automatic payments. They're small, but they're effortless. It's a 2-minute change that can save you $50 a year, every year. Now for the final category, and it's the one that feels like finding a hidden treasure map. Affiliation discounts. Insurance companies are giant data mining operations. They have determined that people in certain professions are statistically safer drivers. Who are they? Engineers, scientists, teachers, pilots, police officers, firefighters, and nurses often top the list. If you are in one of these fields, you could be missing out on a discount of up to 15%. You have to ask. It doesn't stop there. Where did you go to college? Many major universities have alumni associations that partner with insurance companies to offer group discounts. Are you a member of a professional organization? A credit union? A wholesale club like Costco or Sam's Club? Are you a veteran or active duty military? All of these groups often have hidden insurance perks. Think of every single group, association, or organization you belong to and ask your agent, do you have a discount for members of? And then you name the group? So now you have your checklist. It should have at least 10, maybe 20 potential discounts on it. Your mission is to get on the phone with your insurance company. Don't email. You want a live conversation. You're going to say these exact words. Hi, I'm calling to do a full review of my policy to make sure I'm receiving every single discount I'm eligible for. This phrase signals that you are a savvy consumer and you mean business. Then you go down your checklist one by one. Let's start with my vehicle's safety features. I have automatic emergency braking. Now let's talk about my profession. I'm a registered nurse. Be polite, but be persistent. This process alone, this single phone call, can save people hundreds of dollars. You are simply claiming the discounts you are already entitled to but were never told about. You've used insider knowledge to stop the quiet overpayment. By now you've plugged the leaks. You've stopped the bleeding. But what if the problem isn't the leaks? What if the entire structure of your policy is wrong? Discounts are just the beginning. The real life-changing savings, the kind that can cut your bill in half, come from fundamentally changing the core of your policy, your coverages, and your deductibles. And that is a minefield. One wrong move and you could be financially ruined. But one right move and you could save $1,000 a year. In the next part, we are going to walk through that minefield together, step by step, to show you how to surgically remove the costs you don't need, without taking on a single ounce of dangerous risk. Alright, let's defuse this thing. Your insurance policy looks like a single terrifying number, but it's not. It's a collection of smaller, separate decisions that have been bundled together for you. And right now, you're likely paying for decisions you didn't even know you made. Our mission here is to unbundle it, to take it apart piece by piece, examine each one under a microscope, and then reassemble it into something stronger, smarter, and dramatically cheaper. Think of it like building a custom suit of armor. You wouldn't just buy one off the rack. You'd make sure it protects your vital organs, but you wouldn't add a 50-pound helmet if you only planned on walking through a quiet field. Most people are driving around with that 50-pound helmet, and they're wondering why their neck hurts and their wallet is empty. So let's start with the foundation, the absolute, non-negotiable core of your policy. There are 3 main parts to your armor: liability, collision, and comprehensive. We're going to call them the Big 3. Get these 3 right and everything else is just an accessory. First and most important is liability coverage. This is the one part of your insurance that has absolutely nothing to do with you or your car. Liability coverage pays for the damage you do to other people and their property. This isn't a suggestion, it's the law. But here's the trap that ensnares millions of people. They only buy the minimum amount of liability coverage required by their state. This is, without a doubt, one of the most financially catastrophic mistakes a person can make. Let me tell you why. Imagine you're driving on a rainy Tuesday. You glance down at your phone for a split second, and when you look up, the car in front of you has slammed on its brakes. You swerve, but you clip its bumper, sending it into a spin. It's a minor accident, no one seems seriously hurt. You exchange information and you think, okay, my insurance will handle this. You have the state minimum liability coverage. Let's say it's 25/50/25. What do those numbers mean? Sounds like code, but it's simple. It means your insurance will pay a maximum of $25,000 for bodily injury to one person, a maximum of $50,000 for bodily injury for the whole accident if multiple people are hurt, and $25,000 for property damage. That sounds like a lot of money, right? Wrong. The car you hit was a brand new Audi. The repair bill for its high-tech bumper and sensor array is $18,000. Your $25,000 property damage limit covers that. But the driver, a successful surgeon, claims the accident gave them a severe case of whiplash. They can't perform surgery for 6 months. They miss out on hundreds of thousands of dollars in income. They get a lawyer. Their medical bills pile up. They sue you. Suddenly, that $25,000 bodily injury limit looks like a joke. The lawsuit is for $300,000. Your insurance company will write a check for $25,000 and then wish you the best of luck. The remaining $275,000? That's on you. And if you can't pay it, they will come after everything you own. Your savings account. Your home. They can garnish your wages for years, even decades. Your entire financial future wiped out by one rainy Tuesday. This is not a scare tactic. This happens every single day in America. So what's the fix? Shockingly cheap. Increasing your liability coverage from the pathetic state minimum to a robust level, like 100/300/100, might only cost you an extra $10 or $15 a month. It is the single best bargain in the entire world of insurance. You are spending a few extra dollars to protect yourself from a multi-$100,000 catastrophe. Don't be cheap here. This is the steel breastplate of your armor. Fortify it. Okay, now for the second of the big three, collision coverage. This one is simple. Collision pays to repair or replace your car if you get into an accident that is your fault. You hit a pole, you run a red light, you back into a ridiculously small parking garage column. This is the coverage that fixes your mistake. The key lever you can pull here is your deductible. The deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. It's typically offered in amounts like $250, $500, $1,000, or even $2,000. Here's the rule. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. The insurance company is making a bet. By choosing a high deductible, you are betting on yourself. You're saying, I'm a good driver. I probably won't get into an accident. But if I do, I can handle the first $1,000 of the repair bill. The insurance company loves that bet, so they reward you with a lower rate. So how do you choose? It comes down to one simple question. What is in your emergency fund? If you choose a $1,000 deductible, you need to be able to write a check for $1,000 tomorrow without breaking a sweat, without going into debt, without it ruining your month. If you can't, your deductible is too high. Raising your deductible from $250 to $1,000 can easily save you 20 to 40% on your collision premium. That's hundreds of dollars a year. Just make sure you have that cash saved and set aside. There's another, more radical way to save with collision. You can drop it entirely. If you're driving an old car, a beater worth maybe $2,000 or $3,000, it might not make sense to pay for collision coverage anymore. Do the math. If your collision premium is $600 a year and your deductible is $1,000, and your car is only worth $2,500, you're paying a fortune to protect very little value. In that case, the smarter move might be to self-insure. Drop the coverage and put that $600 you save every year into a separate savings account. In a few years, you'll have enough saved up to buy a similar car if yours gets totaled. Finally, the last of the big three, comprehensive coverage. This is your protection against chaos. It's for damage to your car that is not caused by a collision. A tree falls on it during a storm. A deer decides to redesign your front grille at 60 miles per hour. A hailstorm makes it look like a golf ball. It gets stolen. This is the weird stuff, the acts of God and criminals. Just like with collision, your main tool for saving money here is the deductible. The same logic applies. A higher deductible will lower your premium. And just like collision, if your car isn't worth much, you might consider dropping comprehensive coverage altogether to save money. So, you've fortified your liability, you've set a smart deductible for collision and comprehensive. Your suit of armor is now solid. Now we get to the surgical removal part. We're looking at all the little add-ons, the bells and whistles that insurance agents love to tack on. Some are valuable, some are pure profit for the insurance company. Let's look at rental reimbursement. This covers the cost of a rental car while your car is in the shop after a covered claim. It usually only costs a few dollars a month. Is it worth it? The answer is a personal math problem. Do you have a second car in your household? Can you work from home for a week or two? Can you carpool? Or use public transit? If the answer is yes, then you're paying for something you don't need. Ditch it. But if losing your car for 2 weeks would be a logistical nightmare that would cost you your job, then those few dollars a month are an absolute bargain. How about roadside assistance? This is the classic trap. It covers things like a tow, a flat tire change, or a jump start. Sounds great, right? But here's the thing. You are probably already paying for it somewhere else. Do you have a AAA membership? You're covered. Do you have a premium credit card? Many of them offer roadside assistance as a free perk. Did you buy your car new or certified pre-owned? The manufacturer often includes it for free for several years. Check your other accounts before you pay your car insurance company for the exact same service. Don't pay for the same thing twice. This last one is a bit more complex and it's called medical payments or MedPay. In some states it's called personal injury protection, or PIP. This coverage pays for your medical expenses and your passenger's medical expenses after an accident, no matter who was at fault. This sounds like a great idea, but again you have to ask, am I already covered? If you have excellent health insurance with a low deductible and good copays, MedPay might be redundant. You're insuring your insurance. However, if you have a high deductible health plan, or if your plan has gaps, MedPay can be a financial lifesaver. It can cover that big health insurance deductible and save you from thousands in out-of-pocket costs. It's a personal decision based entirely on your existing health coverage. Look at what we've just done. We've transformed you from a passive customer into an active architect of your own protection. You're no longer just accepting a price. You are making a series of intelligent, informed decisions. You've beefed up the coverage that protects your entire future, and you've identified the expensive, unnecessary junk that you can throw overboard. You are now in control. You've built the perfect policy on paper. But how do you get the absolute rock-bottom price for it? Most people think the next step is to just start calling agents and getting quotes. They're wrong. There's a critical step before you ever speak to an agent. A secret weapon that can slash your quotes by another 20 to 30% before you even pick up the phone. And that's exactly what we're covering next. So what is this secret weapon? What's the one thing you can control that insurers are looking at with a magnifying glass before they ever even calculate a premium based on your car or your driving history? It's not a coupon. It's not a special promotion. It's your credit-based insurance score. Now hold on. Before you click away thinking, oh great, another lecture about credit scores, you need to understand this is not your FICO score. It's not the number you see on Credit Karma, or the one your bank shows you when you apply for a loan. This is a separate, specialized score that is one of the single most powerful factors in determining what you pay for car insurance in almost every state. And almost nobody talks about it. Insurance companies spend billions of dollars on data. They are, at their core, risk assessment machines. And over decades, their data has shown them an undeniable, rock-solid correlation. People who are responsible with their finances are, on average, less likely to file insurance claims. It's not about judging your character. It's cold, hard statistics. From their perspective, a person who meticulously pays their bills on time, manages their debt, and lives within their means is statistically more likely to perform regular oil changes, replace their tires when they're worn, and drive more cautiously. They see financial responsibility as a proxy for overall responsibility. So, they created the credit-based insurance score. It pulls information from your credit report, things like your payment history, your level of debt, the length of your credit history, but it weighs them differently to predict one thing and one thing only: the likelihood you will file an insurance claim in the future. And the impact this score has on your rates is staggering. It can be more influential than getting a speeding ticket. It can be more significant than the type of car you drive. Let me paint you a picture. Let's imagine two people, we'll call them Alex and Ben. Alex and Ben are, for insurance purposes, identical twins. They're the same age. They live in the same zip code on the same street in identical houses. They both drive the exact same 2022 Honda Accord. They have the exact same clean driving record, no accidents, no tickets, nothing. They both want the exact same coverage. Same liability limits, same deductibles, everything. On paper, their insurance quotes should be identical, right? Wrong. Alex has spent the last 2 years being diligent with his finances. He pays every bill on time, even if it's just the minimum. He keeps the balances on his credit cards low, well under 30% of their limits. He hasn't opened a bunch of new accounts. His credit-based insurance score is excellent. Ben, on the other hand, is a little more chaotic. He's not a bad person, he's just busy. He sometimes forgets a credit card payment by a few days. He's maxed out a store card to buy a new TV. He recently applied for a few different loans to see what he could get. His driving record is perfect, but his financial record is messy. His credit-based insurance score is poor. When Alex and Ben call the same insurance company on the same day to get a quote, the difference is jaw-dropping. Alex is quoted $120 a month, a fair price. Ben is quoted $195 a month. That's $75 more every single month for the exact same coverage on the exact same car by the exact same driver. Over a year, Ben is paying $900 more than Alex, purely because of a secret score he probably didn't even know existed. $900. That's a vacation. That's a new set of tires. That's your entire emergency fund. All of it gone because of something that has nothing to do with how he drives. This is the game being played behind the curtain. And if you don't know the rules, you are guaranteed to lose. So how do you win? How do you become Alex? You take control of the data before you ever ask for a quote. This is the prep work that separates the people who get average rates from the people who get rock-bottom rates. Here's your 3-step action plan. First, you need to see what the insurers see. By federal law, you are entitled to a free copy of your credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, once a year. The only place you should go to get this is annualcreditreport.com. That is the official government-mandated site. Don't go anywhere else. Get your reports. You're not looking at the score, you're looking at the raw data. The list of accounts, the payment history, the balances. This is your battlefield. Second, you launch a 2-pronged attack on the most important factors. The number 1, most heavily weighted component of your insurance score is payment history. Not paying on time is like getting a speeding ticket on your financial record. You must, without fail, pay every single bill on time, even if it's just the minimum payment. Set up automatic payments. Put reminders in your phone. Do whatever it takes. One late payment that's 30 days past due can tank your score and stay on your report for 7 years. It's a killer. The second prong of the attack is your credit utilization ratio. This is just a fancy term for how much of your available credit you're using. If you have a credit card with a $10,000 limit and a $3,000 balance, your utilization is 30%. You want to keep this number as low as possible and absolutely under 30%. If you have high balance cards, focus on paying those down first. This shows insurers you're not overextended and you're not in financial distress, which in their eyes makes you a better risk. Third, you become a detective. Scour your credit reports for errors. It is shockingly common to find mistakes. A bill from a collection agency you already paid off. An account that isn't even yours. A late payment that you know you paid on time. Every single one of these errors is like a hidden anchor, dragging your score down and driving your insurance rates up. If you find an error, dispute it. Each credit bureau has a straightforward online process to file a dispute. They are legally obligated to investigate it. Getting a single negative error removed can cause your score to jump significantly, saving you hundreds of dollars. Now, it's important to note, a few states have seen how powerful this is and have said, no more. If you live in California, Hawaii, or Massachusetts, congratulations. They have banned the use of credit information in setting car insurance rates. Michigan has also placed heavy restrictions on it. For everyone else, that's 46 other states. This is the reality. Your financial health is directly tied to your insurance premium. Doing this work, checking your reports, paying bills on time, lowering balances, and cleaning up errors 6 months before you shop for insurance is the single most powerful thing you can do to lower your rates. It's the ultimate leverage. You are cleaning up your profile so that when the insurance company's algorithm pulls your data, it sees the digital equivalent of a perfect student, a responsible homeowner, a safe bet. You're transforming yourself from Ben into Alex before the quote is ever generated. But this is only half the battle. Polishing your profile is step 1. Step 2 is knowing exactly what to ask for when you finally make the call. Most people just ask for a quote. That's a rookie mistake. A quote is just the starting price. The real savings are buried in a complex web of discounts, And most agents will not voluntarily offer you every single one you qualify for. You have to know what they are and demand them. There are the obvious ones like a good student discount. But then there are the obscure ones, the ones that are hidden deep in the underwriting manuals. And one of the most powerful and most misunderstood is how the simple act of combining policies can unlock a level of savings most people think is impossible. It's not just about bundling home and auto. There's a right way and a very wrong way to do it. And the wrong way can actually cost you more money in the long run. We're about to break down the science of stacking discounts, starting with the biggest one of all. That biggest discount is the multi-policy discount, more commonly known as bundling. And on the surface, it seems incredibly simple. You have your car insurance with Company A, you have your home or renter's insurance with Company B. You move them both to Company A, and they slash your rates. The commercials show happy families saving hundreds, even thousands of dollars a year. And it's true, the bundling discount is often the single largest percentage-based discount an insurance company offers, sometimes as high as 25%. But the insurance industry has a dirty little secret about how this discount actually works, and understanding it is the key to unlocking real savings instead of falling into a costly trap. First, let's understand the psychology from the insurer's perspective. Why are they so eager to give you this massive discount? It's not out of the goodness of their hearts. It comes down to two words: stickiness and data. When you only have one policy with a company, say your auto insurance, you are a flight risk. Every 6 months you might get a renewal notice, see a price hike, and immediately start shopping around. It's easy to switch. But when you have your home and your auto insurance with them, that's a different story. The renewal dates might be different. The hassle of moving two policies, coordinating the start and end dates, and filling out twice the paperwork makes you far less likely to leave. You become a sticky customer. They might lose a little on the margin with the discount, but they gain a customer they can likely keep and slowly raise rates on for years to come. That long-term value is worth a fortune to them. The second reason is data. A person who owns a home is, statistically speaking, a more stable and predictable insurance risk than someone who doesn't. They tend to be more financially responsible, have more established roots in a community, and are less likely to engage in high-risk driving behaviors. By bundling your home policy, you're not just buying another product. You're giving the insurance company a giant flashing sign that says, "I am a lower-risk individual." They reward that data signal with a discount because their models show you're less likely to cost them money. So, knowing this, how do we exploit it for maximum savings? This is the right way to bundle. You never ever just call your current car insurance company and add a homeowner's policy. That is the single biggest mistake people make. Why? Because you have no leverage. They know you're already a customer, and they'll give you their standard take-it-or-leave-it bundle offer. The right way is to shop the bundle as a single new product to multiple companies at once. You must treat yourself as a brand new customer to everyone, including your current provider. Your mission is to find the lowest combined price for the exact same coverage. This is critical. You need to create a simple spreadsheet. Column 1, the company name. Column 2, the 6-month auto premium. Column 3, the 12-month home or renter's premium. Column 4, the total annual cost. You then call or go online to at least 3 to 5 different insurance companies. You tell them, "I am looking for a quote to bundle my home and auto insurance." You give them your current coverage limits, the exact same numbers for liability, collision, comprehensive, and for your home's dwelling and property coverage. You want an apples-to-apples comparison. Now here's where the secret comes in. Insurance companies don't apply the bundle discount evenly. They play a shell game with the numbers. For example, Company A might give you a quote with an incredibly cheap auto insurance rate, let's say $500 for 6 months. You're thrilled. But they've quietly quoted your homeowner's insurance at $2,000 for the year. Meanwhile, Company B quotes your auto insurance at $700 for 6 months, which seems higher. But their homeowner's quote is only $1,200. If you only looked at the auto insurance price, you'd pick Company A every time. But let's do the math. Company A's total annual cost is $1,000 for auto plus $2,000 for home, which equals $3,000. Company B's total annual cost is $1,400 for auto plus $1,200 for home, which equals $2,600. Company B is $400 cheaper, even though their car insurance looked more expensive. This is the trap. Insurers lure you in with a massive, heavily advertised discount on one policy, while quietly inflating the price of the other. The only number that matters is the final total combined annual cost. That's why you need the spreadsheet. You cannot trust the percentage they advertise. You can only trust the final dollar amount you'll be paying out of your bank account. This is the very wrong way to bundle, falling for the convenience and the advertised discount without doing the math. Let's imagine a guy named Frank. Frank has had his auto insurance with Big Red Insurance for 10 years. He's a loyal customer. He buys a house and calls them up. Hey, I want to add a homeowner's policy and get that loyalty bundle discount. They say, absolutely, Frank. We love our loyal customers. We'll give you 20% off your auto insurance for bundling. Frank is ecstatic. He signs the paperwork without getting a single other quote. What he doesn't know is that while they gave him a $250 discount on his car insurance, their homeowner's policy was $600 more expensive than the national average for his exact house and location. Frank is now paying $350 more per year than he should be, all while thinking he got a great deal. He fell for the trap. Don't be Frank. And this principle extends beyond just home and auto. The more you can bundle, the stickier you become and the bigger the potential discount. Do you have a motorcycle? A boat? An RV? An ATV? Ask about bundling those. The real power-up, however, is something called an umbrella policy. An umbrella policy is extra liability coverage that sits on top of your auto and home policies. It protects your assets if you're sued for an amount that exceeds your standard coverage limits. For example, if you cause a major car accident and your auto policy only covers up to $300,000 in liability, but you're sued for $1 million, an umbrella policy could cover the $700,000 difference. It's an incredibly important policy for anyone with assets to protect. And here's the kicker. Adding a $1 million umbrella policy to your bundle can sometimes deepen your multi-policy discount so much that the umbrella policy itself is practically free. The discount you get on your home and auto for adding it can be equal to, or even greater than, the cost of the umbrella policy itself. It's one of the best deals in insurance, and most people have never even heard of it. Now, for the master-level strategy. This is something your insurance agent will almost never tell you. Sometimes the cheapest option is not to bundle at all. This sounds like heresy after everything we've just discussed, but it's true. Some insurance companies are hyper-specialized. You might have one company that is incredibly aggressive and cheap for auto insurance in your specific state and for your specific car, but their home insurance product is terrible and overpriced. And you might find another company, a smaller mutual company perhaps, that offers fantastic, affordable homeowners insurance but doesn't even sell auto. If you do your shopping, and you must do the shopping, you might find that Super Cheap Auto Incorporated can insure your car for $800 a year, and Rock Solid Home Assurance can insure your house for $1,100 a year. The total is $1,900. The best bundled quote you could find from a single company was $2,200. In this case, by splitting your policies, you save $300. The convenience of one bill is not worth $300. You should always compare the best bundle offer against the best separate offers. Takes an extra 30 minutes of work, but that work could pay you $300. That's a $600 per hour wage. I take that job any day. So your action item is this. Find your current insurance declaration pages for both your car and your home or renter's policy. Add up the total annual cost. Then go to the websites of two companies you're not currently with and get a bundled quote for the exact same coverage. Just see. In 20 minutes, you'll know for sure whether you're leaving hundreds of dollars on the table. But what if you don't own a home? What if you're a renter? Or you just can't find a bundled deal that makes sense? Don't worry. The biggest discount is powerful, but it's not the only one. The next set of discounts we're going to talk about have nothing to do with owning property, and everything to do with proving you're a better driver than your neighbor. In fact, your insurance company is willing to spy on you to give you this discount, if you let them. This is the world of usage-based insurance, or UBI. You might know it by brand names like Progressive Snapshot, State Farm's Drive Safe and Save, or Allstate's DriveWise. The industry calls it telematics, and it's the single biggest shift in how car insurance has been priced in 100 years. For decades, insurers have been forced to guess how you drive. They look at your age, your zip code, your gender, your credit score, and they lump you in with millions of other people who look like you on paper. They make an educated guess. But telematics changes the game. Stops the guessing. It's like a Fitbit for your car, tracking your actual behavior and reporting it back to the mothership. In exchange for this data, they offer you a personalized discount based on one simple thing: how safe of a driver you actually are. So how does this spying actually work? There are two main ways they collect this data. The old school method, which is still used by some companies, is a small device, a dongle, that you plug into your car's OBD2 port. Now for most of us that sounds like something out of Star Trek, but it's actually super simple. It's a small port that's usually located under your steering wheel, near your knees. It's the same port your mechanic uses to diagnose a check engine light. You plug this little box in, it syncs up, and it quietly starts monitoring your car's behavior. The newer and now far more common method is through your smartphone. You download your insurance company's app, give it a few permissions, and it uses the powerful sensors already built into your phone, the GPS, the accelerometer, the gyroscope, to figure out when you're driving and how you're driving. This is less intrusive because there's no hardware to install, and it's often more advanced, capable of tracking things a simple plug-in device can't. But what are they really looking for? What data are they collecting that could save you hundreds of dollars a year? It boils down to a few key metrics that are proven indicators of risk. First and most importantly, braking. Specifically, hard braking events. To an insurance company, slamming on your brakes is a massive red flag. It means you were either following too closely, you weren't paying attention to the road ahead, or you were in a situation that almost became an accident. A safe driver anticipates stops. They see the yellow light from a block away and coast. They leave a safe following distance. The telematics program logs every single time you brake hard, and the fewer of those events you have, the better your score. The flip side of that coin is rapid acceleration. Flooring it from a red light might feel good, but to your insurer, it screams aggressive driver. It's a sign of impatience and a tendency to take unnecessary risks. It also wastes a ton of gas, but they're not grading you on that. They see a lead foot as a predictor of future claims. A smooth, gentle acceleration is the mark of a calm, low-risk driver. Next up is the time of day you drive. This is a big one. Driving at 2 p.m. on a Tuesday is statistically world safer than driving at 2 a.m. on a Saturday. The roads are clearer, there are fewer drunk drivers, and visibility is better. The algorithms know this. If the bulk of your driving is during standard, low-risk hours, like a typical commute or running errands during the day, you'll score much higher than someone who works a night shift or frequently drives late on weekends. Of course, they also track total mileage. This is the simplest metric of all. The less you're on the road, the less opportunity there is for you to get into an accident. In the age of remote work, this has become a huge discount opportunity for millions of people. If you've gone from driving 15,000 miles a year to just 5,000, telematics is the most direct way to prove it and get rewarded for it. And finally, the one that makes people the most nervous, phone usage. This is where the smartphone apps have a huge advantage. They can tell if you're actively using your phone while the car is in motion. Are you texting, scrolling, or making handheld calls? That is the single most distracting thing a driver can do, and these apps are designed to bust you for it. If you can prove you don't touch your phone while driving, you are demonstrating an elite level of safety, and the discount will reflect that. So, the million-dollar question, how much can you actually save? The discounts are real, and they can be significant. Most companies will give you a small participation discount, maybe 5 or 10%, just for signing up and trying the program. From there, your final discount is based on your driving score over an evaluation period, which is typically 90 days or the first 6 months of your policy. For good drivers, the savings usually land in the 15 to 25% range. For truly exceptional drivers, the ones who are smooth, drive at the right times, and never touch their phones, discounts can climb as high as 40%. Imagine cutting your bill by almost half, just by proving you're the safe driver you already claim to be. But there is a critical warning here. While many companies promise they won't raise your rates based on the data, this isn't a universal rule. Some can and will surcharge you if the data reveals you're a much riskier driver than they thought. It's absolutely crucial to read the fine print of the specific program you're signing up for. Ask your agent directly. Can my premium go up based on this data? This is a double-edged sword, and you need to be honest with yourself about your driving habits before you sign up. So, who is this perfect for? It's a dream come true for a few types of people. First, the genuinely safe and cautious driver. If you're the person your friends make fun of for driving exactly the speed limit, this is your vindication. Second, low-mileage drivers. Retirees, students who live on campus, and especially remote workers. This is your chance to stop subsidizing the supercommuters. And third, it can be a golden ticket for young drivers. A 19-year-old with a lead foot pays a fortune because they're lumped in with every other reckless 19-year-old. But if you're a teen who can use this app to prove you're a responsible driver, you can shatter that stereotype and earn a discount that would otherwise be impossible to get. On the other hand, who should probably avoid it? Be honest. If you have a bit of a temper on the road, if you're always in a hurry, if you treat traffic laws as mere suggestions, this program will expose you. It will not save you money. Likewise, if you work the graveyard shift or are a bartender who drives home at 3 a.m. every night, the time of day penalty will likely work against you, no matter how safely you drive. And finally, if you have major privacy concerns, this might not be for you. You are, without a doubt, trading a slice of your privacy for a potential discount. You have to decide if that trade-off is worth it. Now, if you do decide to go for it, you can absolutely maximize your discount by understanding the system. Think of it like a video game where you're trying to get the high score. First, practice the graceful stop. Look far ahead down the road. When you see brake lights or a stale green light, take your foot off the gas immediately and coast. This will drastically reduce your heartbreaking events. Second, imagine there's a delicate egg sitting on your gas pedal. Apply pressure smoothly and gently. No jackrabbit starts. Third, make it a habit to put your phone in the glove compartment or center console before you even start the car. Set your music or navigation beforehand. Out of sight, out of mind, and out of the hands of the app's tracking algorithm. Finally, remember that the initial evaluation period is the most important. Be an angel for those first 90 days. Drive perfectly. That's the score that will lock in your discount for the next policy term. You can use the app's dashboard to check your score and see what you need to work on. It's your report card. Use it to study for the test. Ultimately, telematics is about shifting from group statistics to individual accountability. It gives you the power to prove you're better than average. It's a direct negotiation between you and your insurer, with your car's data as the evidence. So we've talked about your home and we've talked about your driving habits. But what about the car itself? The machine you're actually insuring? It turns out the specific make, model, and even the hidden features inside your car can unlock a whole new layer of discounts that most people never even ask about. In fact, there's one safety feature that became standard on all cars in 2012 that could be saving you money right now, and you might not even be getting credit for it. That feature is electronic stability control, or ESC. So what is this magical feature? Think of it as a guardian angel for your car. It uses a network of sensors to detect when you're starting to skid or lose control, like on a patch of ice or a sharp, wet corner, and it automatically applies the brakes to individual wheels to straighten you out and keep you on the road. The National Highway Traffic Safety Administration found it so effective at preventing single vehicle crashes that they made it mandatory on all passenger vehicles sold in the United States, starting with the 2012 model year. Here's the crazy part. Because it was an optional feature on many cars from the mid-2000s up to 2011, your insurance company might not know your specific car has it, even with your VIN number. Their system might just see a 2010 Toyota Camry and not realize yours is the XLE trim that came with the optional stability control package. They assume you don't have it, so you don't get the discount. You are being a safer driver in a safer vehicle, but you're paying the same premium as someone in the base model. A simple phone call to say, "Hey, I'm just confirming the safety features you have on file for my vehicle. Do you show that it has electronic stability control?" Could instantly save you 5 to 10%. But this goes so much deeper than just one feature. This is about conducting an audit of your own vehicle. You know your car better than anyone. Don't just assume your insurer does. Let's talk about a guy named Mark. Mark bought a used 2011 Honda Accord. It was in great shape, low miles, a solid, reliable car. He got his insurance quote online, punched in the VIN, and accepted the rate. A year later, he was reading the original owner's manual he found in the glove box and saw a section on side curtain airbags and vehicle stability assist, which is Honda's name for ESC. He realized his trim level had these features, but they weren't standard on every Accord that year. A light bulb went off. He called his agent and said, "I'm looking at my car's original specs, and I want to confirm you have it listed with side curtain airbags and stability control." The agent checked. No, their system didn't have it flagged. After Mark confirmed the features, his premium dropped by $8 a month. Now, $8 might not sound like a life-changing amount of money, but that's $96 a year. Over the 5 years he plans to own that car, that's nearly $500. $500 for a 5-minute phone call. He got a retroactive credit for the past 6 months too. This is found money. So right now I want you to think about your car. Does it have anti-lock brakes? Daytime running lights? What about more modern features like blind spot monitoring, lane keep assist, or automatic emergency braking? Each of these is a potential discount. Car manufacturers give them all sorts of fancy marketing names, so you might have to do a quick search for your make and model to know exactly what you have. But once you have that list, call your insurer and go through it with them line by line. Don't assume. Ask. Verify. And it's not just about surviving a crash. It's about preventing your car from being stolen in the first place. This brings us to anti-theft discounts. These are often overlooked but can be incredibly valuable. Insurers break these down into a few categories. First, you have passive devices. These are things that arm themselves automatically. The single most common one is a factory-installed engine immobilizer. If you have a key with a thick plastic head, there's a good chance there's a tiny transponder chip inside. The car won't start unless it recognizes that specific chip. This has been standard on most cars for over a decade, but are you getting credit for it? Ask your insurer if they have a passive immobilizer discount on your policy. Next are active devices. These are things you have to manually turn on, like a car alarm you arm with a key fob, or even a physical lock like a steering wheel club. The discount is usually smaller for these, but it's not zero. If you use one, you should be rewarded for it. Then there's the top tier, vehicle recovery systems. This means GPS-based tracking like LoJack or a manufacturer service like OnStar. If your car is stolen, this technology can help law enforcement track it down and recover it. To an insurance company, this is huge. It means instead of having to pay out the entire value of your car, a total loss, they have a high chance of just dealing with a much smaller repair bill for a broken window or a damaged ignition. Because it so drastically reduces their potential payout, the discount they give you can be substantial, sometimes as high as 20 or 25% on your comprehensive coverage. If you bought a used car, it might even have a system like this installed from a previous owner that you don't even know about. It's worth checking. Now let's shift gears from the car itself to how you use it. This next strategy is, without a doubt, one of the most powerful ways to lower your insurance in today's world. And it's especially true for anyone whose work life has changed since 2020. I'm talking about the low mileage discount. Insurance is a game of risk. The more you're on the road, the higher the chance you'll be in an accident. It's simple statistics. When you first signed up for your policy, your agent or a website form asked you to estimate your annual mileage. You probably thought about your daily commute, weekend errands, and maybe a road trip and came up with a number, say 12,000 miles a year, which is close to the national average. And then you never thought about it again. But what if you work from home now? What if that 45-minute commute each way is gone? Your car, which used to rack up 250 miles a week, now might only see 50. You are no longer an average driver in terms of risk, but you are still paying an average premium. Insurers don't just give a flat discount. They use tiers. For example, the rate for someone driving 15,000 miles a year might be the same as someone driving 11,000. But the moment you drop below 10,000 miles, you enter a new cheaper tier. Drop below 7,500, and you hit another one. The biggest savings often come when you can classify yourself as a pleasure use driver, typically under 5,000 miles a year. This can slash your premium by 15, 20, or even 30%. Think about Sarah, a graphic designer. Pre-pandemic, she was driving 15,000 miles a year. Her company then went fully remote. Her car sat in the garage most days. She called her insurer, told them her situation, and provided her current odometer reading. They reclassified her annual mileage to 6,000 miles. Her 6-month premium dropped by $77. That's over $150 a year she was essentially throwing away because her policy didn't reflect her new reality. Go look at your odometer. Check your service records from a year ago. Figure out how much you're actually driving, and if that number is significantly lower than what your insurance company thinks it is, make the call. But what if you want to take this even further? What if you're not just driving less, but you're also a genuinely safe and careful driver? This leads us to the final and perhaps most controversial strategy in this section. Usage-based insurance, also known as telematics. You've probably seen the commercials for programs like Progressive Snapshot or State Farm's Drive Safe and Save. The idea is simple. You let the insurance company monitor your driving habits, and in return for that data, they give you a personalized discount based on how safe you actually are. This is done through either a small device that plugs into your car's diagnostic port or an app on your smartphone. It tracks things like hard braking, rapid acceleration, what time of day you drive, driving at 2 a.m. is riskier than 2 p.m., and of course how many miles you drive. For the right person, this is a revolutionary way to save money. If you're a smooth driver who accelerates gently, keeps a safe following distance, and avoids late-night trips, you can prove to your insurer that you're a low risk. You're not just a 25-year-old male, you're this 25-year-old male who drives like a grandpa, and you can get a discount of up to 40% for it. It separates you from the bad drivers in your demographic. However, there is a catch, and it's a big one. You have to ask one critical question before you sign up. Can my rate go up based on this data? In some states and with some companies, the answer is yes. If the little device reports that you're constantly slamming on your brakes and peeling out from stoplights, they can actually surcharge you at your next renewal. You entered the program to save money and ended up with a higher bill. So you have to be honest with yourself. Are you a calm, defensive driver? Or do you have a bit of a lead foot? Do you live in a dense city where hard braking is a daily, unavoidable reality? If so, a telematics program might not be for you. But if you're confident in your safe driving habits, it could unlock a level of savings that no other discount can touch. We've covered the discounts tied to your car and the discounts tied to your driving. But there's a third massive category of discounts that has nothing to do with either. It's all about who you are, your profession, your education, and the groups you belong to. These are called affinity discounts, and they are the easiest, most overlooked savings in the entire insurance industry. And they could be saving you money right now based on a job you had 5 years ago or a school you graduated from a decade ago. Let's break this down because the concept is so simple, yet almost nobody takes full advantage of it. Insurers have mountains of data on us. They know that, statistically, an engineer from Georgia Tech is less likely to get into a major accident than the general population. They know that a high school teacher with a master's degree and 20 years in the classroom is probably a more responsible, predictable driver. They know that members of certain credit unions have higher credit scores, which, as we've learned, directly correlates to lower risk. So what do they do with this data? They make a bet. They bet that if they offer a small discount to everyone in that group, all the Georgia Tech alumni, all the teachers in a specific union, all the members of that credit union, they will attract a flood of low-risk, profitable customers. It's a brilliant marketing strategy for them, and a massive untapped savings opportunity for you. The insurance company gets a pre-screened pool of good drivers, and you get a discount not for how you drive, but for who you are and the groups you belong to. Think of it like a secret menu at a restaurant. It's not advertised on the big board, but if you know to ask for it, you unlock a whole new set of options. These affinity discounts are the insurance world's secret menu. Let's get specific. I want you to mentally or even physically start making a list right now. We're going to build your personal discount portfolio. First category, your profession and employer. This is the big one. Do you work for a large company? A Fortune 500 corporation like Microsoft, Google, or General Motors? They almost certainly have a partnership with at least one major insurer. But it's not just tech giants and car manufacturers. If you are a government employee at the federal, state, or even local city level, you likely qualify for a discount. Are you a teacher, a firefighter, a police officer, or a nurse? These are considered stable, low-risk professions, and insurers actively court you with special rates. They literally have lists of professions they target. Engineers, scientists, accountants, architects, doctors, lawyers. If you're in a licensed profession that requires years of education and a stable career path, you need to be asking about this. The discount can range from 5% to as high as 15% just for the job you do every day. Second category, your education. Where did you go to college? Major universities have massive, powerful alumni associations. These associations exist to provide benefits to their graduates, and one of the most common benefits they negotiate is a group discount on insurance. Harvard, Stanford, University of Michigan, University of Texas. If you have a degree from a large state school or a well-known private university, go to your alumni association's website right now. Look for a benefits or partnerships page. You will almost certainly find a deal with a major carrier. And here's the key. It doesn't matter if you graduated 2 years ago or 20 years ago. Your alumni status is for life, and so is the potential discount. Even belonging to a specific fraternity or sorority can qualify you. These Greek organizations have national chapters that also negotiate these group rates for their members. Third category, membership organizations and clubs. This is where it gets really interesting because you might be a member of a group that offers a discount and not even realize it. The most famous one is AAA. People join for the roadside assistance, but often overlook the substantial insurance discounts they offer, either through their own insurance company or in partnership with another. Then there's AARP. If you're over 50, An AARP membership can unlock some of the most competitive rates on the market, specifically designed for mature drivers. But what about wholesale clubs? Are you a member of Costco or Sam's Club? Both have partnerships that offer their members specially negotiated car insurance rates. People rave about the savings they get through Costco's program in particular. What about a credit union? Unlike big, for-profit banks, credit unions are member-owned, and they are constantly looking for ways to provide value back to their members. Group insurance rates are a perfect way to do that. If you bank with a credit union, you must inquire about their insurance partners. Could be one of the best discounts available. Think about any professional organization you belong to: the American Medical Association, the National Education Association, the Institute of Electrical and Electronics Engineers. If you pay dues to a professional group, part of what you're paying for is their collective bargaining power. Go check their member benefits page. Fourth, and critically important, military service. If you are an active duty service member, a veteran, or a direct family member of one, you are in a special category. Companies like USAA and Geico were literally built around serving the military community. The discounts they offer are not just a small percentage off. Their entire rate structure is often fundamentally lower for military-affiliated individuals. They view service as the ultimate sign of responsibility and low risk. If you have any connection to the armed forces, this should be the very first discount you investigate, as it is often the most significant of all. So now you have this list: your past and present employers, your university, your fraternity, your professional groups, your warehouse club, your military service. What do you do with it? You go on the offensive. This is not a passive activity. You cannot wait for your insurance company to call you up and say, "Hey, we noticed you're an engineer who went to Purdue and you're a member of Costco, so we're going to lower your bill by 18%. It will never happen. You have to be the one to initiate. Here's the 3-step action plan. Step 1. Go to the websites of your organizations first. Your alumni page, your company's internal HR portal, the AARP or AAA member site. Look for the insurance partner they advertise. This gives you a starting point. Step 2. Call your current insurance provider. Don't just ask, "Do you have any discounts for me?" That's too vague. You need to be specific and methodical. Go down your list one by one. Say, "I'm calling to do a discount review on my policy." First, do you offer a discount for employees of your company name? Wait for the answer. Okay, thank you. Next, do you offer an alumni discount for graduates of your university? Wait for the answer. Great. How about a discount for members of your professional organization? Be polite, but be persistent. You are not asking for a favor. You are inquiring about established corporate programs that you are entitled to. Sometimes the agent on the phone might not even know all of them. You might have to ask them to check their system thoroughly. You are the project manager of your own savings. Step 3, and this is the power move: compare the offers. You might find that your university's partner offers an 8% discount, while your employer's partner offers 10%. Or you might find that the company Costco partners with gives you a quote that's 25% lower than what you're paying now, even with your current discounts. This is not about loyalty to one company. This is about paying the lowest possible price for the exact same coverage. Imagine a driver. Let's call her Sarah. Sarah is a software engineer for a big tech company. She graduated from a large state university. She's also a member of AAA for roadside assistance. She's been with the same insurance company since college, and her rates just keep creeping up. She's a perfect driver, no accidents, no tickets. Sarah's probably overpaying by hundreds, maybe even $1,000 a year. Her employer has a 10% discount with one carrier. Her university has an 8% discount with another. And AAA has its own program. By not investigating these 3 simple affiliations, she is leaving a staggering amount of money on the table, month after month. Don't be like Sarah. You need to take an hour of your time, build your list, and make the calls. This is the single highest leverage financial task you can do in an afternoon. Finding just one of these 10% discounts could save you $200 a year every year, for the rest of your driving life. It is the definition of a force multiplier for your finances. Now that you've gathered all this intelligence, you know your risk profile, you've optimized your deductibles and coverages, and you've built a master list of every single discount you qualify for. You have all the ammunition you need. But having ammunition and knowing how to win the war are 2 different things. You are now prepared for the final ultimate step. This is where we take all this knowledge and use it to make the insurance companies compete against each other for your business. It's the grand finale of savings, the one strategy that ties everything together and can slash your premium in a way that no single discount can. It's time to learn how to properly shop for insurance and force the system to give you the lowest possible price. Let's start by shattering the biggest myth in the insurance industry: the loyalty discount. For decades, we've been conditioned to believe that sticking with the same company year after year earns us some kind of special treatment, a reward for our faithfulness. The truth? In many cases, loyalty is not rewarded, it's penalized. It's a phenomenon industry insiders call price optimization, but a more honest name would be a loyalty tax. Here's how it works. Insurance companies have incredibly sophisticated algorithms. They know that a customer who has been with them for 7 years, never files a claim, and always pays on time is very unlikely to leave. So, at each renewal they might raise your rate by just 3%, then 4%, then another 3%. These small increases are designed to fly under your radar. They're just small enough that you won't go through the hassle of shopping for a new policy. But over 5 or 10 years you could be paying hundreds, even thousands more than a brand new customer for the exact same coverage. The company is banking on your inertia. They are optimizing their price based on your loyalty. They are taxing you for being a good customer. The single most powerful way to combat this, to take back control, is to prove their algorithm wrong. You have to be willing to walk. You have to shop around. So how do you do it right? It's not about randomly plugging your name into a dozen websites. It's a strategic process, a mission. Step 1. Prepare your dossier. Before you make a single call or click a single link, you need your intelligence file. This includes the driver's license number for every driver in your household, the vehicle identification number, or VIN, for every car, and an estimate of your annual mileage. Most importantly, you need a copy of your current policy's declarations page. This is the holy grail. It's the one-page summary of your exact coverages, limits, and deductibles. Without this, you're flying blind. You can't compare apples to apples. You'll be comparing apples to lawnmowers. You can find it in your online account or ask your current agent to email it to you. Do not skip this step. Step 2. Define your coverage. Look at that declarations page. Is this the coverage you actually want? As we've discussed, state minimums are dangerously low. This is your chance to decide what level of protection your family truly needs before you start getting quotes. Decide on your liability limits. Are you comfortable with $100,000? Or do you need $300,000? What about your comprehensive and collision deductibles? Is $500 the sweet spot? Or could you handle a $1,000 deductible to lower your premium? Make these decisions before you shop. This prevents you from getting confused by quotes that offer wildly different levels of protection. You're not hunting for the cheapest price. You're hunting for the best price for the right coverage. Step 3. Launch the three-pronged attack. To truly canvass the market, you can't just rely on one method. You need to hit the insurance world from 3 different angles simultaneously. The first prong is the direct writers. These are the giants you see on TV every 5 minutes. Companies like Geico and Progressive. You deal with them directly, usually through their websites or an 800 number. Their business model is built on volume and technology. Go to their websites, enter your information from your dossier, and within about 15 minutes, you'll have a quote. Get at least 2 or 3 quotes from these direct writers. This will form your baseline price. The second prong is the captive agents. These are agents who work for one single company like State Farm, Allstate, or Farmers. You can't get a quote from them on a comparison website. You have to go directly to them. Why bother? Because a good captive agent knows their company's rulebook inside and out. They know every single discount their company offers, and can often find savings that a website's algorithm might miss. They can be a valuable advisor, but remember, they can only sell you one brand of insurance. Find a local captive agent and have them run a quote. Now for the third prong, your secret weapon, the independent agent. Unlike captive agents, independent agents don't work for just one insurance company. They represent dozens of them. They are your personal insurance shoppers. They take your information one time and then submit it to a whole portfolio of carriers, including many excellent regional companies you've probably never even heard of, companies that don't spend $1 billion on advertising and can often pass those savings on to you. An independent agent does the legwork for you. They bring the market to your doorstep. This is, without a doubt, the most efficient way to get a wide range of quotes and find hidden gems in the marketplace. Once you've launched this 3-pronged attack, you'll have a collection of quotes. Now you can sit down with your declarations page and make a true apples-to-apples comparison. You'll see who is truly offering you the best value. But how often should you go through this process? There are 2 key timelines. First, you should make it an annual financial ritual. Put it on your calendar for the same month every year, about 30 to 45 days before your policy renews. Treat it like a yearly checkup for your wallet. Second, you must shop anytime you have a major life event. These events are massive flags in the insurance algorithm that can dramatically change your rates, for better or for worse. Buying a new car? Shop around. Moving to a new zip code, even just across town? Shop around. Getting married? Your combined profile could unlock huge discounts. Shop around. Adding a teenage driver to your policy? You absolutely must shop around, as some companies are far more forgiving of young drivers than others. Did a ticket or an accident just fall off your record after 3 or 5 years? That's a huge cause for celebration and an immediate reason to shop for a new rate. Did your credit score jump up significantly? That alone can save you hundreds. Every one of these events resets the game board, and the company that was cheapest for you last year may now be the most expensive. A final note on negotiating. You can't haggle an insurance rate like you're buying a car. The rates are filed with and regulated by the state, but you can have a conversation. Once you have your best quote, call that agent or company. Go over the quote line by line. Ask them, are all possible discounts applied here? Is there anything else we can do to lower this premium without sacrificing crucial coverage? You might discover you're eligible for a discount for your occupation, for having an alarm system, or for paying your premium in full. It's not about haggling the price. It's about ensuring you're getting the best possible price that their system can offer. And there you have it, the final, most powerful piece of the puzzle. Over these 10 parts, we've built a complete toolkit for mastering your car insurance. We've talked about the profound impact of your driving record and your credit score. We've dissected how the car you choose to drive can save you a fortune before you even buy it. We've uncovered a universe of discounts, from telematics to bundling, that most people leave on the table. And now you know the ultimate strategy: how to properly and relentlessly shop the market, forcing companies to compete for your business, not the other way around. This knowledge is power. Car insurance is not just a bill you have to pay. It's a financial product you can manage, control, and optimize. It's a game, and for the first time, you have the complete rulebook. Your mission, should you choose to accept it, is to stop passively accepting your renewal notice and start actively pursuing the rate you deserve. Find your declarations page. Set a date on your calendar. Make the calls, get the quotes, and take back the money that is rightfully yours. You now know how. The rest is up to you.